currently in private.
3. Order. Welcome to this morning's session of the Business, Energy and Industrial Strategy Select Committee for our hearing today on energy bills and the future of the energy market. For our first panel this morning, I'm delighted to welcome Jonathan Brearley, CEO of Ofgem. Good morning. Neil Lawrence, who is the Retail Director from Ofgem, and Neil Kenwood, who's the Director for Strategy and Decarbonisation. Welcome to all three of you this morning. Mr. Brearley, just to you first, I'd be interested to hear your views on the narrative that in a similar way to the financial crisis when the banks went bust and required taxpayers' money, with the energy crisis right now, 29 companies gone bust so far, I understand it, £2.5 billion being loaded onto consumers. Isn't this a failure of Ofgem to effectively regulate and supervise the energy market?
Well, let's look back at the root causes of this crisis, and we have seen an unprecedented and extraordinary scale and change in the wholesale gas market. We can't find historically a change that's had the pace, the scale and sustainability that we've seen before. So gas prices across winter are 5 times what they were last year, for example. Now, first and foremost, that has led to a huge rise in customer bills, and the announcement we made last week of £700, I know, is extremely worrying for customers. I spend a great deal of my time talking to customers and talk to them directly before we made the announcement about the impact on their lives. And I know this is coming at a time where they're facing other much bigger financial pressures at the same time. So this is a combination of things we know will hit customers hard. Equally, as you mentioned, we've seen 29 supplier exits since the start of the year, and we know that's affected around 4 million people. Now, I need to be clear, as a regulator, I hope we never have to go through either of those two things again. Now, when I look at some of the other root causes as to why this is the case, it's clear that, first of all, we had to focus on protecting customers. So we made sure that customers were on supply. We made sure that credit balances were protected. But we also know that our regulation needs to change. And I'd just like to highlight 3 big areas that's partly about our regulation, but partly about our approach to regulation overall. So first of all, the price cap has worked. So it protected customers across winter. And if you look back in its history, it has made sure that customers are paying no more than they need to for their energy. But without doubt, it's going to have to become more flexible and more adaptable now that we are in what is quite possibly a more volatile energy market overall. So we've already put forward a set of reforms that we think will make that difference, and we're happy to expand at this committee. Equally, though, financial regulation needs to be tougher. We need a retail sector that's more resilient and more able to deal with the kind of shock that we've seen. And to be clear, Chair, we accept that had we done that earlier, this would have been better for customers. Finally, I want to talk about culture and the way the regulator has worked with the sector and others in this area. Now, it strikes me, when I look back across our history of decision-making, that the relationship between Ofgem and retailers is quite different to the relationship Ofgem has with other parts of the sector, for example, networks. And I do think we are going to need to work more closely and more collaboratively in the way we shape not only our financial regulation, but our regulation of the sector overall. If we are moving, as I suspect we are, to a sector which is less reliant on switching as the only mechanism to drive up performance and to manage price, then we will need to form a different kind of regulation, and that's something that I think will need to involve much more closely the retailers themselves, consumer groups and other stakeholders to make sure we shape that in the right way. Now, if I were to strike an optimistic note, I say that coming out of this crisis, accepting all of the challenges this has posed for the country, I think we could build out of this a retail sector that is suitable not only to manage these problems, but to get us closer to our net zero targets in a cost-effective way.
Thank you. I mean, the increase in wholesale gas price is an obvious problem, but the issues you've raised around a closer working relationship with energy companies, financial resilience in energy companies, issues around consumer credit, surely these things could have been done without there being an energy crisis in the first place. Why hadn't they been done already?
So when you look back at the history of Ofgem's decision-making, let's just take the financial resilience as an example. Without doubt, there was a consensus that Ofgem was part of that we needed to diversify the market. And when I look back at the history of our decision-making, particularly in the mid-2010s, it was clear that that was the number one priority. Now, what happened at that time is when representations were made, the priority was given to getting smaller suppliers into the market. And therefore, some of the measures that were put forward weren't implemented at the pace or the scale that I think, with hindsight, that we needed. So without doubt, there was a perspective at the time. We need to diversify the market. We need to challenge what was the dominance of the big incumbent companies. And just to say, that wasn't just Ofgem, that was the CMA and others. And that's what dominated thinking at the time. It's my view that we should have combined that with greater financial resilience. And if I were to highlight 3 strategic points, first of all, when we opened the market, it would have been better had we had higher barriers to entry then. Secondly, and most importantly, when we introduced the price cap, which introduced a different dimension to this market, which, I'm sure we'll come on to, means that the costs of failure are much higher because we need to make sure everyone gets access to energy at that price cap level. And thirdly, clearly after COVID, although we did move, we could have moved further than we proposed in the regulations that we put in place.
Thank you. Let me just touch on some of those. So firstly, on consumer credit, I mean, you said we wanted the market to be competitive, so we weren't as tough on financial resilience and some of the financial regulations as we needed to be. I mean, I understand that in the price cap increase that was just announced, £54 million was included to cover lost credit, consumer credit, from companies that had gone bust. But that only reflects, I think, about 15 of the companies that had gone bust at that point. We're already double that now, nearing 30. It's been estimated, I think it was the CEO of Centrica who said that he thinks about £400 million of consumers' money has gone missing as a consequence of these companies going bust. Is that right?
So I don't think it will reach that level from the figures that we have.
What level do you think it will be?
So at the moment, in the settlements we've made so far, it's about 3%. We think, and this isn't a firm estimate, that may rise to about 10% of the overall level.
What does that mean in real money from consumers?
So that would be about, let's say, £7 out of the existing settlement, maybe rising up to £10.
At the moment, it's £2.45, and that
That's
accounts
right.
for 54 million. So if you think it's going to be £10, you're thinking it might be 200 million.
Something like that. Now, those figures aren't figures that we finished with. We're still going through those, but roughly of that order of magnitude. But the vast majority of the cost has been down to re-hedging people when they move from a failed supplier to another supplier. And that's about 85% of the costs that we're seeing.
Why wasn't consumer money ring-fenced so that companies couldn't spend it on other business costs?
So we had a proposal that was already in train to ask suppliers to return their credit balance to customers every year, which would have managed that cost. So that was already being implemented, but it wasn't finalised. But the argument, and when I look back at the arguments that were made, the argument was that this would make it very hard for small suppliers to operate. And as I say, if you go back through our history, there was a view that we needed to encourage small suppliers into the market. It's our view that we do need to ring-fence those credit balances further, and we're looking at mechanisms to do that. The complexity is, and the thing that we're working on right now, is that if you are going to ring-fence them, we want to make sure that ring-fence is insolvency protected. So what you don't want to do is ring-fence customer balances and then find that just gets washed up in the general form of an administration. So that's what we're working on now. And we're bringing forward proposals, I think, next month.
I think you started the discussion on ring-fencing consumer credit in March 2021. Why couldn't it have happened sooner? Why did it wait for the energy crisis for this to come forward?
So we had proposals out in consultation, and look, there is a very, very set of mixed views on ring fencing. So we were seeking views on what was a proposal that would force companies to pay back customers every year, which would have reduced that ring fenced amount. I think that it was simply the process of consultation, and that does take time.
Presumably the energy companies didn't want to ring fence it because they wanted to use it as working capital.
Some did, some didn't. And there was also views from customers. So the proposal we had out there that you return money back to companies was actually quite controversial amongst customers as well as amongst companies.
And do you think it's right that consumers should have to pay back around £200 million through their energy bills of their own money that's gone because of the bankruptcy of energy companies that weren't regulated properly?
So I think we should ring-fence customer credit balances more firmly. So I agree that with hindsight we should have ring-fenced customer credit balances more firmly.
I mean the recovery now, so in the price cap, consumers are having to pay back the money that was essentially their fellow consumers' money that were lost when companies went bust. Is it right that that goes on energy bills, or should it come from somewhere else?
Well, ultimately, the system we have, the only place we can recover these costs from are on energy bills. And overall, the proportion is very small. So as you say, it's about £2.40 now. The majority of the costs that have come through the solar process really are around re-hedging suppliers to keep people on energy at the price cap.
And I understand that energy companies already had to provide some form of financial reporting to you as the regulator. Could you just explain that? Was that a frequent reporting, or was it an annual reporting? How did that work?
So we had, after COVID, we had very frequent reporting of financial information. Now, over time, that ramped up. When we saw that gas prices were rising in July last year, that then began to include quite detailed information about hedging, and now it's weekly. So every week we get information from companies about their hedging position and about their overall financial position. But what we are doing now is going beyond that and asking companies to run stress tests for us. that not only look at their position, but look at what that position would be under a set of scenarios and circumstances.
And again, why wasn't that done before?
Well, I think when you look at the proposals that we had, I think the difference and the shift we have to make is the financial responsibility proposals were really targeted at what we thought would be, if you like, the edge cases or the worst part of the market. And I think what we accept we need now is something that's much, much more comprehensive.
And you said about the financial reporting since COVID. What was it before COVID?
Before COVID, we used to have what we called a watch list of companies, and that relied on a series of indicators that would identify when a company was in financial stress. So, for example, delays in payments of renewables levies and things like that.
Pre-COVID, there wasn't active supervision and reporting of energy companies' financial position?
Certainly not to the extent there should have been, no.
Okay. And then during COVID, presumably you saw that some energy companies were in a tricky position, and there was a period of time, albeit during a pandemic, before the energy crisis kicked off, when you knew that energy companies were not as resilient as they ought to be. Is that right?
So yes, and in summer, so you remember, I think there's now a letter that's now public that we sent to government that explained our concerns. In summer, we came forward with the statutory consultations that laid out the financial responsibilities that we put in place in January of that year. Now, one reflection I have is there are legal requirements on us to take time to consult. So it isn't as simple for any regulator simply to put measures in place. So if you play the time it took to consult, the time it took to implement those principles, and then the time to get the guidance in place, that does often take months, and it did in this case.
Okay, thank you. Nusrat Ghani, please.
Thank you, Chairman. Mr. Berry, it feels like you're giving us an example of what happened, and all I'm hearing is it's a bit too little, too late. A lot of it's in hindsight. A lot of the processes in place were post-COVID. And you mentioned in your statement earlier on, you mentioned the retail sector, you mentioned that Ofgem should have been more resilient. And I think you said, and I wrote it down, so forgive me if I'm misquoting you, had we done more earlier, that would have been better for customers. So do you accept that the poor decision-making has led to customers paying higher bills?
Look, I think we need to recognise the context at the time. And at that time, there was enormous pressure, I think, indeed, from the House as much as anywhere else, and there was concern about the fact that we had a small number of incumbents and huge concern that customers who weren't switching, or indeed switching between them, were getting poor service and poor value for money. So in my mind, it's understandable why the regulator focused on diversity, but what I accept is that alongside that, we should have been more careful about the financial resilience of those who were coming into the market.
And you mentioned it was an unprecedented situation. But what I'm failing to understand is where was the risk management or any strategies in place for you to foresee what was going to happen? Because one could argue it's happened quite slowly, and at any point you could have intervened to help the customer.
Well, I think this comes back to how we are able to implement regulations. So when we saw the gas price rise, we did, as I say, respond by collecting information. We did issue provisional orders to two companies who we were most concerned about, one of whom was Avro. But the problem is, after that, the pace and scale of the gas crisis was actually quite quick. And if you look at the supplier failures, particularly the ones that affected customers, most of those happened in September and October. And our organisational focus, given the scale of what we were seeing, had to be to protect the customers of those companies, and that's what we did.
You're now in a place where you are putting your stress testing you've spoken about, you're looking at indicators for change. So this is a slightly broad question, but I want to know how Ofgem is just basically doing its analysis. So can you explain what analysis you're doing at the moment on the impact of energy prices if Russia was either to cut off or to reduce natural gas supply? What would that mean to the customer?
So what we do, and what we've done since the start of the crisis, is run a series of scenarios. And I have to explain that the volatility we've seen this winter is extraordinary. I'm going to take you back to a very dark moment in the regulator just before Christmas when the price got to £4.50 a therm, which we've never seen before in the market. And what we do to manage that is we run a whole set of scenarios, one of which is extreme high prices. You'd expect that to come through, for example, if Russia were to invade Ukraine. But we do also have concerns about prices falling extremely quickly and the turbulence that impacts on the market. So we have a series of scenarios against which we test the outcomes for companies and for customers.
Could you just be a bit more, I want you to knuckle down and tell me what would be the difference to the price to the customer if, as you said, Russia was to invade Ukraine? What analysis have you done? What can you tell us?
So I'm going to ask Neil to come in on the impact on prices, but just to give you a kind of benchmark, if you look at the price cap we just announced and that £700 rise, that moves the implied price in the price cap from about 70 pence to I think it's about £1.30. Now, it's really hard to say what the price would be if Russia invades Ukraine, but let's say the average price over the course of the price cap goes to £200 or more, you would be seeing significant rises again in the price that people pay, if that were sustained. And Neil, I don't know if you want to sort of add any more detail to that.
Happy to. The critical thing to understand about the price cap is the way the wholesale element is set is by looking at futures markets over a 6-month observation window that happens before the price cap period itself. And so that's why people's estimates of what the price cap will be get more and more accurate as we get closer to the announcement date, because that observation window is filling up with the data. And what the data is telling us now, if you look at the futures markets for next winter, is that is suggesting there could be a further increase in the price cap. But actually, we don't know that yet, because our observation window has only just started. And so we're just literally a few days into it. And over the course of the next 6 months, markets will respond to events like Russia, Ukraine, and other factors, and that will then determine the price cap level in the coming winter. So it really is impossible to say at this point what the prices will be.
Just to come back to your question, we do know that if, we expect, we're not experts at geopolitics, but we expect if Russia invades Ukraine, and let's say there was a sanctions regime that meant Russia limited gas to Europe, that would drive high price rises, and yes, that would ultimately feed through to customers, and that could be of the scale of what we've seen before.
You've got the analysis, you must have it by percentage points. If natural gas was limited by 10 or 20%, what that would mean to the customer in the UK. Do you have that data at all?
So we can absolutely give you all of those figures, and we can explain how we do it, and we can show you the scenarios we run and what that might mean for prices.
Fantastic. One of the things that you also mentioned in your statement was your relationship now with customers, because you want to know what the customers are saying, what they're feeling, and what the circumstances are. You put that forward in your statement. So if you're focused on the customers, and obviously you're focused on giving them the best value for money, can I reflect on your thoughts on what Germany is doing to try and keep costs low? So the German government plans to lower energy bills by reducing the cost of supporting renewable energy projects. From this year, the German government will cut a green surcharge that appears on home energy bills from 6.5 cents per kilowatt hour to 3.7 cents. And the German government plans to cover the outstanding levies by using £3.3 billion collected by the Treasury via carbon taxes. I know you mentioned net zero in your opening statement. Is this not an option that we could use, reducing green levy, to make sure the customers can afford to pay their bills, or is that not something you're prepared to look at all?
So that's ultimately not for us. That's ultimately for government. So it's a choice for them. Clearly it is possible, but there are a set of trade-offs that the government needs to make.
A lower bill?
Well, can I just focus on renewable levies and the impact they've had over the course of this, because I do think there's an important point here. The relative cost of renewables versus the cost of gas in the market today makes those technologies extremely cost effective. And one of our renewables levies, which are different to Germany, is actually vastly reduced, because those projects are paying back to customers now because their costs are much lower. Neil might be able to just expand on the impact the contracts of difference are already having, which is reducing those levies.
That's right. So normally, or traditionally, historically, money has been paid out to pay for contracts for difference, but contracts for difference are set at a fixed price, and that's been the main mechanism for procuring new renewable energy over the last 7 or 8 years now. And because they're set at a fixed price, when the market price goes above that contract price, they actually pay back to consumers. And so in the coming period, we would have expected a £22 contribution to the price cap from contracts for difference. That now is set at 0 and could actually, depending on the turnout of data, could actually pay back to consumers.
Actually pay back or will pay back?
It depends on the turnout of the data.
A lot of it depends. And I think we're just focused today making sure how we...
But the point here is, so to come back to your question, levies are coming down already.
Good. And then my final question to you, Mr. Brady. What did you make of the announcement on the 3rd of Feb on the energy price cap, and how do you think that's going to impact household energy bills?
So we've looked back and we can't find a price rise as high as the one that we announced. And as I say, I spend a great deal of my time talking to customers in all sorts of vulnerable circumstances. And we know this has a huge impact on their lives. And what we want to do with the industry and with government is do everything we can within our powers and our role to be able to offset that. But I have no doubt about the seriousness for many families across the UK.
Thank you.
Thank you. A supplementary from Mark Jenkinson.
Thanks, Chair. I just want to probe on the levies, the contracts for difference. What's the lag on seeing that paid back? Are these levies on a quarterly basis, on an annual basis? Or?
They get settled through the LCCC on a quarterly basis. That's the Low Carbon Contracts Company. And so what we're able to do with confidence is set that at a level of virtually zero, I think, or possibly zero, in the price cap period that's coming. So the 1st April price cap is set at essentially zero for contracts for difference.
So the price cap that we're about to see implemented has nothing in it for contracts for difference, but will have obviously other renewable obligations, warm homes, insulation programs, boiler replacement, things like
exactly
that.
Different schemes, yes.
Yeah. Okay, thank you.
The overall total cost for those collection of green policies is now lower than it was in the previous price cap period.
Thank you.
Thank you. Alan Brown, please.
Thanks, Chair. Just want to ask a couple of questions to try and get a handle on how effective the cap is. So just want to say, first of all, how many customers are on standard variable tariffs or default tariffs that are protected by the cap, but also how many are on these default tariffs and they're not protected by the cap because they're exempt, because they maybe use higher than average energy and things like that. Because I've got constituents struggling to pay their bills, and I'm asking their energy supplier why is she not protected by the cap, and that was the answer, but she uses higher than average energy consumption. So I just want to see how effective that is.
Yeah, look, I mean, what the cap really is a cap on the unit charge. It's a cap on how much you pay per unit. So actually that varies for every household across the country. Now, we've tried to find the best way to communicate this when we talk publicly, and the best way we can find is to take an average household and say what this does for an average household bill. But clearly, that's going to vary by different households. For those who use more, they're still going to continue to pay more, but equally for those who use less, they will pay less. I don't know if you want to add anything to that.
Yeah, I mean, everyone is protected by the price cap unless they've signed up to a fixed tariff deal, which is obviously their choice, that may be or usually would be lower than the price cap historically, but those deals aren't cheaper now. But everybody gets that protection from the price cap.
Well, you're saying everybody gets that protection, but that's what I'm saying. I've got a constituent where she's now paying more than the cap because, well, I suppose it was yourself, John, said it's a unit rate rather than an absolute cap. So.
And it's 22 million households.
I believe 22 million, yeah.
Okay, and in terms of regional variations, I notice on Ofgem's website it does say there's regional variations based on network charging and cost of moving energy about effectively.
Yes.
I presume then, though, that because it's a unit rate, that doesn't take into account, because the reality is you've got a regional variation in energy demand, because if you live in the north of Scotland, quite clearly you're going to use more energy to heat your home. So does that not then mean the concept that's explained as this £2,000 a year, that doesn't apply to them either, because it's a unit charge, so if they're using more energy, they're paying a lot more money?
This is something we've wrestled with ever since we've had the price cap inside Ofgem. So what we do when we make the announcement is try to find the best way to explain to customers what might change on average. But you're right, there are variations. There's variations in location because network charges vary by location, and there's variations in the amount people use. We are really open to ideas about how we can make that communication better, because when we explain it in those terms, it clearly becomes very complicated and very hard for people to get a sense of the change that's being made. The best way to think about it, in my mind, is to look at the percentage uplift, and that usually gives you an indication of the scale of the price rise for people.
Okay, in terms of regional variations, there's a historic issue in the Highlands and Islands of Scotland where people on restricted meters pay an additional surcharge, so I think it's an average 4 pence a unit more of electricity. But yet the Highlands and Islands obviously is a net exporter in terms of generation of electricity. Is that not an anomaly that Ofgem as a regulator should be looking at or discussing with government in terms of that penalty that's applied to customers?
I'm really happy to take that away. I don't know if you've got any further comments.
I don't know the detail, I'm sorry, but yeah, let's come back to you on that.
We'll have to come back.
That would be good. And can I just ask one more? Because it's a unit price then again, rather than an absolute cap, what does it mean for customers that are off-grid, that are therefore more reliant on electricity? I mean, how does the cap work for these type of customers? So
the cap, we actually calculate two separate caps, one set that applies to electricity and one that applies to gas. So it's the same process. And of course, each individual off the grid will have different arrangements. Some will have electric heating, some may have other forms of heating, oil, boilers, etc. So those are not regulated by the price cap, but the electricity obviously is.
Yeah, thanks.
Thank you. Mark Pawsey, please.
Thank you, Chairman. And Jonathan Brearley, you said earlier that the price cap has worked. I want to ask you one or two questions about the price cap. Isn't it the case that by having a 6-monthly review, we've had a sudden shock, this massive increase that you've just announced, and in the absence of a price cap, consumers would have seen perhaps a more gradual change and they'd have been better able to deal with it?
So, look, just to clarify, the price cap has worked prior to the gas crisis. We do think it needs to change and it needs to adapt more frequently. However, what we saw in other countries that didn't have a price cap was very, very sharp prices very, very quickly. So when we look at the other deals that were on the market that were unregulated, you would have seen sharper and higher price rises. Now, you could argue that when prices come down, those prices might also reduce equally sharply. But I think what it says to me is, in a sense, that price regulation has played a role for customers over winter. It has led to a sharp uplift that we're seeing right now. What I think we need to do, at a minimum, is make sure that we update it more frequently, so that is more attenuated, as you described.
So you change it more regularly than 6-monthly?
Yes.
Okay, because I was going to come on to that, because one of the concerns we might have is that in 6 months' time, market prices might have fallen, but it's likely that we're going to have to effect a further increase. So we're going to end up with this situation where the price cap is going in one direction while market prices are going in the other. How do we explain that to our constituents?
Well, I think that's part of the change we want to see. So I think when you look at the history of the price cap, and not very long history, but the history of the price cap, in a fairly stable market, these things have really been edge issues compared to the changes that we've seen. But in a volatile market, that's absolutely the issue we've seen with the price cap design, and that's why we're saying, so our front-runner option for change for October will be to change every 3 months, so those changes are passed through more frequently. I should say that consumer groups, I think, net accept the proposal that we're suggesting, and I think I'll talk to consumer groups next, but there's a degree of discomfort with that, because that does leave people with a more volatile pricing situation. So there are big trade-offs there, but overall, I agree with the premise that we need to change it more frequently.
And when the price cap was introduced, it was brought forward as a temporary measure. It's been renewed. Do you ever foresee a situation where we don't have a price cap?
So I think it's quite possible. So,
it's going to stay with us forever.
So I think it's quite possible that we do see a situation where there's no price cap, but I think you need the market to change quite considerably.
What would enable us to do away with the price cap?
Well, we apply a set of tests that say, well, is the competitive market working effectively enough that we are comfortable that those customers, particularly those who don't switch, are going to be able to get an effective deal out of the market. But you've got to remember, we think we're going to need to move to a very different retail market in the future. So if you think about a world in 5 or 10 years' time where we are seeing a great deal of reliance on electricity, we're seeing heat pumps, we're seeing electric vehicles, indeed the report last week from this committee around what we might see means that what we want to encourage customers to do is to move their usage over the course of the day, and that does mean a more frequent change in price.
Government introduced the price cap essentially because consumers weren't switching enough.
Well, I'm not sure that's the diagnosis I would apply, and I do think this is when I look back at our history and I think about the debate that was there and frankly the regulatory philosophy that was behind it, the issue in my mind is not that people aren't switching enough, it's that it's quite easy to segment customers. So, for example, if you take another sector that's relatively competitive, let's look at supermarkets. You don't expect everyone to change every supermarket to get the best deal. It's the marginal customers that drive down the price for everyone. What you see in energy, unfortunately, is it's relatively easy, a bit like you see in financial services, to put a ring fence around those people who switch and offer them a particular deal and leave those who are steady on deals that ultimately become more expensive. And that loyalty penalty was the reason why the price cap was introduced.
And given that many consumers who did switch have been caught by suppliers who've gone bust, they switched because Ofgem there was a campaign to encourage people to do that. They're perhaps regretting that decision now. How are you going to get people to switch in the new world once everything settles down? They may not want to do it anymore.
So I think this is why the financial resilience proposals are so important, and that's why we're pursuing them at pace, because we do need customers to have confidence in the ability to switch between companies. And I think as we build up those proposals and as the market becomes more resilient, I think we will see opportunities for people to switch. Equally, I think the economics will change at some point, and the economic advantage of switching will be as robust as ever.
Thank you, Chair.
Thank you. Mark Jenkinson, please.
Thank you, Chair. Just to follow on some of that line, we've got 22 million households currently sitting on the price cap, which is about 4/5. My understanding is that hasn't increased massively from the number of households that normally would not be on fixed tariffs. Maybe not.
I think it has increased quite substantially.
What would be the usual number?
It would normally, so last summer it was more like 15 million, and what's happened is that as people who are on fixed tariffs have come to the end of their deals, they've looked in the market, and actually, as Jonathan was saying, that the fixed tariffs are obviously much higher at the moment, so people are defaulting onto the price cap standard variable tariffs, and that's causing problems, but it's actually providing really important protection for consumers.
15 million is probably just over half of UK households. Is it not the case that the price cap is disincentivising switching? So it removes the incentive to switch, and that's why we end up with so many sitting on the price cap and energy suppliers effectively subsidising them as it is at the minute.
I suppose we'd got to the point before the current crisis where almost half, as you say, of households were switching, were actively engaging. I think that's historically really encouraging to see those active choices being made by consumers. So I think it was on a helpful trend, but obviously the current gas crisis has led to people rationally taking shelter on the price cap tariffs.
So I think just to come on that, when the price cap was introduced, there was concern from us and from others that somehow this would limit the amount of switching, and that's not what the evidence has shown. But I think it comes back to this point. You still have a large number of people who are not switching, a large number of people who want to stay on the standard variable tariff. And I think when we think about the future of retail regulation, when we think about how are we going to drive up customer service standards, we may have to accept that as more of a reality and therefore think differently about how we're going to make sure that other things customer wants get implemented.
Thank you. So what's the likelihood of the price cap raising again in October, and what will be the main factors that determine whether it does?
Well, I'll kick off and Neil wants to comment. As Neil says, when you look at the forward prices right now, there is upward pressure in prices still, so you may see a rise in October, but the caution I have in sort of predicting that is I went back and looked at what we predicted in August when we announced this price cap, and the difference between those predictions, which were the price cap will stay roughly level, versus what we've seen, are huge. And to be honest, I look, as you can imagine, too frequently at the changes in the gas market. In fact, it's, you have to watch yourself. You can watch it much too much. The market really is looking at some factors which are fairly binary. And your member has already mentioned the Russia-Ukraine situation. That will clearly have an impact on supply, and that will clearly have an impact on price. So I'd caution against any projections, but if we just look at the forward market, so what the traders think right now, then it does look like there's upward pressure on prices.
Well, wholesale prices will be the determining factor.
They will be by far the main determinant of the price cap level come the winter.
Just to say, almost always they are, even in smaller rises. That's what drives the price cap up and down.
So is there anything that we can do, or anything anyone can do in the short term to mitigate potential rises, whether it's government or suppliers? Or?
So look, I thought hard about this, and as we came up to the announcement and we saw the scale of this announcement rising, we've looked hard at what Ofgem can do, and we do have rules that we apply to suppliers and how they treat vulnerable customers. We do have a voluntary agreement with the industry, but quite frankly, the scale of these rises really can only be met by government action. So ultimately, it's a matter for government as to what they do to respond, and they've announced a package last week. As I'm sure you'll understand, it's not my position to comment on whether that's a good or a bad package, but this is something that only government can intervene to address the scale of what we've seen. That's not to say we won't play our part. That's not to say the industry won't do what it can, and I hope they do. But this is of a scale that is simply not really what anybody else can manage.
Thanks, Chair.
Can I just check? So we're expecting the price cap to go up again in October?
Well, I think to be clear, we don't know. So when we look at the forward markets, there is upward pressure right now, but those forward markets have been extremely bad predictors of what might happen in October.
Right. Yeah.
Just so I come back, Mr. Brennan, you were talking about your statement in August on the prices. Now, I've just used one, and you said you look at the futures market too much. I have not, but I've looked at the Dutch TTF numbers.
Yes.
In August in July of last year, the number was 40.7, and in August it was 50.3, and in September it was 97.8. At no time in the previous 5 years had the number been higher than 24. Why on earth did you not think there was going to be an increase when you looked at these numbers in July and August?
So when we looked at these numbers in July and August, our expectation was that we would see more supply than came forward. And so, we, quite frankly, we were looking at the changes. We did look at what the implications for the price cap, but we didn't understand the dynamic would change so dramatically to lead to what we saw.
This is my point, Chair. It had already changed. There was no time in all your time at Ofgem the prices have been anywhere near that level. This price was 80% higher than anything you'd seen before, and your decision was, we'll see.
Well, we looked at it. We issued the RFI on hedging, so we started looking at people's hedging data, but we didn't project what we saw now.
Okay. Why did you think supply was going to increase and then it didn't? What was the key reason?
Well, look, it's not my position to comment on geopolitics, but when you look at the market, you've got two factors that I see broadly. You've clearly got a higher level of demand from Asia. So we got three factors. You did have low storage in the end of last winter. You've got a high demand from Asia, but in a tight market, those who supply any product have a chance to influence price. Now, one of the things I'm sure this committee has looked at is the amount of gas that has come from Russia over that time. And that has had, at times, a dramatic increase on price.
So low storage of gas in the UK was a problem?
I don't think this is about UK storage. It's about general. It's not so much about low storage capacity. It was about what was full at the time, and that's a European issue.
Okay. And of the half or 50% of households who were switching before all of this kicked off, what percentage of them were on auto-switching deals, where they weren't actually looking for themselves to find a deal and making the decision, but were on platforms that were switching them to the lowest price automatically?
I don't have that data. Sorry, we can get back to you with that.
It's a relatively small amount compared to most switches, but we'll come back to you.
Because the concern on auto-switching is it was just defaulting people automatically to the lowest price, which was fueling the problem with often smaller challenger companies underpricing in order to try and then make up the money later on and then time ran out. That's right?
So look, I mean, we've had concerns raised to us about auto-switchers, and certainly when you look at the attitude that suppliers have to customers from those books, it is one way you expect people to move automatically to the lower price. If you have a market where people aren't financially resilient, then clearly that does exacerbate the problem. We don't have regulatory powers over switching sites or switching companies, but part of the mitigation we're putting in place is the financial resilience, so those choices are more constrained.
Sorry to jump around, but you said storage was a European problem. Why is it a European problem? Shouldn't we have capacity for our own storage in the UK?
So look, I mean, there's a government question about how much capacity we need, but my point was less about the level of capacity. It was about how it was filled up. So it wasn't about how many holes in the ground, it was about how full they were.
It was filled with Russian gas.
So it wasn't filled with Russian gas. That was
you were expecting it to be, and it wasn't. Okay, understood. Thank you.
Can I just ask a quick question about the auto switching that you?
Please.
Yeah, thanks. You're saying there, Jonathan, you've got concerns about auto switchers, but the long-term stated ambition for the government is that people need to opt out from auto switching. So if they've caused a problem today, does that not mean there needs to be significant reform before we can ever get to the place where switching is by default, auto switching is the default option then?
So look, I think we have to be clear that there was a shared ambition across the regulator and government to increase levels of switching. And switching was seen as the main driver for price and indeed for customer service. I think we would say our reflection now is that switching does play a substantive part in that, but we need to look more broadly at how we regulate the retail sector to make sure that customers do get out of it what they need. The government did come forward with auto-switching proposals. One was opting in and the other was opting out. But I think they've paused that as part of their wider retail review, and that's really a matter for them.
But the timescales, do you think, for that to be practical?
So I think ultimately that's part of their retail review, and I think they need to make a decision first about whether they're going to bring it forward.
I think we have a quick supplementary from Nance.
I do, on storage again, Mr. Brierley. I don't expect you to provide us the government's response, but you must have an idea, if we had more storage, fuel storage, what that would mean to the customer in prices or not.
So look, the problem is we are in a global gas market.
Yeah.
So I think the honest and candid answer I can give without taking responsibility for government decisions is that ultimately it would have a marginal impact on the overall price because it would be a contributor, but a relatively small contributor to a global gas market. What it might do is increase resilience, but that's ultimately a matter for government.
So it might increase resilience, but if we had more domestic storage, would it not provide some resilience and then reduce the price? Or are you just thinking about the storage that we had previously, sort of around 2010, or if we had more now?
Just doing the mental maths here, if we had more storage, it would help because there would be more gas availability. But you've got to compare that to the size of the market and therefore the supply versus the demand that you're seeing. And, you know, we haven't done the full analysis. It's for government to do that. But my expectation would be it would have a marginal impact on price.
Yeah. The experts that we, or I at least, have spoken to in global gas markets, they do say that it wouldn't make a significant difference to the UK price because the UK price is set globally.
So it comes down to the dynamics of the gas market. We don't get very much gas from some major suppliers like Russia, but it has an impact on the price because others do.
Thank you. Tonia Antoniazzi, please.
Thank you, Chair. Following your announcements on the 3rd of February, on the 4th you announced reforms to the energy price cap mechanism. What were your key announcements about changes to the energy price cap and what impact do you expect these to make?
So, as Jonathan says, we had the unfortunate duty of having to announce a significant rise in the price cap level, and the sort of main benchmark price cap went up by £693 to £1,971, and as we've described, that the main driver by far of that was the increase in wholesale energy prices. We also set prices for PPM customers and for people who pay on a cash and cheque basis. So those were the key announcements, and all of those price cap levels saw a significant rise, and we do fully understand that puts enormous pressure on millions of families up and down the country.
In the meeting yesterday that I participated in, you said about there possibly being a quarterly update on the price cap. Is that something that you're seriously looking at, and why would it be beneficial?
That's right. So we published a consultation document on Friday that looked at all the benefits of the price cap, but recognised that actually at times of extreme market volatility, the price cap struggles to respond in a timely way, and that creates risks in the market and risks ultimately for consumers. So we put forward two potential changes to the price cap methodology. The first one would be moving to quarterly updates, as Jonathan described. That's our preferred option at the moment, and that could be implemented by October. And then there's an alternative option that we're seeking stakeholder views on, which is around moving to price cap contracts, which would be a set of rolling contracts that people would take as part of the price cap. That would be the new SVT. So we're keen to get stakeholder views on these, but as I say, at the moment our preferred option is quarterly. That would mean more regular changes for consumers, but hopefully smaller steps with each one. And it would reduce risks to suppliers, which, as we understand, obviously leads ultimately back to cost on consumers.
Just to add to that, I mean, I think that there are trade-offs here, and there is a degree of discomfort with us changing the price more frequently, particularly if you make a change in winter, for example, where clearly for customers, particularly those on prepayment meters, that might mean a significant change at a time when you're using most of your energy. And what we're really trying to do here is to get the balance right between making sure that customers, and principally making sure that customers pay a fair price for their energy, but making sure the price cap can adapt to a changing market that changes as dramatically as the one that we've seen.
Yeah. Mr. Brealey, we've just seen in the news that, major oil companies have made rather large profits, and you said that it was up to the government to intervene. Would a windfall tax on these profits be beneficial to the customers in the immediate or long-term future?
Look, there's two things I'm told as a regulator. One is not to get involved in policy, and the second is definitely not to get involved in tax decisions. So I think that's probably the answer.
Okay. I'll move on. So moving on to the energy retail market, what extent have the failures in the regulation of the market exacerbated the impact of the gas crisis on household bills? Of these failures?
Out of the rise that we announced, £68 is the levy cost of paying for those failures. Now, the main driver of that cost, the vast majority of that cost, is down to paying the wholesale cost of re-hedging customers, so making sure that every customer who's moved has access to energy at the price cap.
Okay, and what measures are you taking to be robust about new entrants to the retail market?
So we already introduced powers in 2019 in the retail market, and none of the companies that came into the market since then have been companies that have failed. So we do have measures in place. We've also said, though, given the volatility in the market right now, we've got a moratorium on new entrants until things stabilise. I think the issue that we really need to tackle is what we do with those who are already here. And we need a much, much closer and more focused monitoring regime to make sure we understand the risk that they're taking early, and therefore we can take regulatory action to avoid that.
Thank you. Andy McDonald, please.
Thanks, Chair. And thanks for this evidence this morning. Just taking a step back from all of this, our constituents, I don't think really care where their gas comes from or their electricity comes from. They don't sort of compare that gas smells better than the other one, or that light burns brighter.
Yes.
They're getting hammered here, absolutely hammered. And when the things have gone into meltdown, you've got the consumer credit costs being taken away. The companies have had their money, and it's been taken away from them. And the onus of this structure is upon the customers to go and seek better deals elsewhere. Is this in any way fair? And is it a fair way to structure an energy policy in this country?
So, look, we make sure that every customer credit balance is protected, but those costs are socialised ultimately amongst other customers. We also make sure that companies are honest and fair in the way that they offer their prices and they compare them. What I would say, I think there is going to be a shift, and particularly when we think about the future of retail, that means we need to think harder about how we regulate that part of the market that doesn't switch. So one of the biggest problems we've had in the last 10 years, and I think that why Ofgem's focus was so much on diversity and so much was on getting entrance into the market, was actually, we felt, and I think everyone felt, that those people who weren't moving weren't getting a good deal. And I think that's why we have the price cap, and that's why we have the sort of pricing regulation we need. One thing I'd just add actually about the price cap is, although we're making changes for October, it may well be we need to reform the price cap further, and we are also starting a conversation about how we make sure that we best deliver the aims of the price cap, which was really to say, for those people who don't switch, how do we make sure they get the best deal?
Okay, thank you. Now, it's estimated that due to the supply of last resort levy claims, £68 is going to be put on to the average customer bill in April, and then presumably if it goes up again in October. Is that process the most effective way of recuperating costs, considering the increase it has on consumer bills?
So look, I think there may well be ways that you can improve it, but in terms of the fact that we have had 4 million customers overall affected, and that we have kept people on supplies, and we have protected their customer balances, in general, it works, but we are trying to work through what might need to change, and we'd be happy to update the committee on that. As we're doing, and I should actually mention this committee, we are doing our own lessons learned exercise. That is something that will be public, and that will be part of it.
Are you able to indicate what those reforms might be now that you can?
Well, there's a series of things. I think particularly the relationship between the insolvency regime and the supplier of last resort process are something that we do need to look at. So, for example, there are the behaviour of companies with administrators, and what those administrators do, for example, to pursue debts, is something that's been raised as a concern to us.
Thank you. And you said earlier, I think about 29 companies have gone bust, 29, 30. What, is there an observation? Why have they gone bust? What's the fundamental reasons for them failing?
So look, there's three drivers. One is the big change in gas price, first of all. Secondly, as we've mentioned, if the financial resilience of those companies wasn't strong enough, and for some of them, regardless of any other intervention, that was the case. But thirdly, what we saw is when companies got into financial distress, what the price cap does do is it stops them responding in a way other companies might respond. Now, the way they would respond is by raising prices quite dramatically for their existing customers, and there's a trade-off there to be made.
And what protections are there for the customers in those circumstances? That's the issue.
So in those circumstances, every customer is transferred to a supplier and they get energy at the level of the price cap.
I just want on Mr McDonald's question about the companies that have exited. Have you got any powers of redress on those companies? Because there's obviously an opportunity for companies to say, hey, we want to get in the energy market. They price themselves low, get lots of customers. They pay themselves a lot of money as executives of these businesses, and then, poof, their business goes bust, but they've paid themselves. What redress do you have in those circumstances?
We don't have redress in those circumstances. I think we should, yes.
I think my questions were answered. Thank you.
Thank you. Alan Brown, please.
So just following on from that, so you're saying obviously some companies can't pass on the costs, you know, the way they could. So out of the 4 million or so customers affected, or the 29 companies, how many of them went bust just because they weren't financially resilient enough and were buying in the spot market, and how many was actually because they couldn't carry the losses of customers on the cap?
Look, we're trying now, actually, as part of that lessons learned process, in a structured way, to find out the balance of those two impacts. You know, frankly, I think the thing that we will find, I expect the thing that we find, is that the improvement in financial resilience that you would need is probably the main driver. But my point is simple, that there are some companies who did hedge properly against the customer book they've had, but have found themselves locked into a price cap that was less affordable, and that's been a reason why they failed. So my view is, if you're thinking about how we change this, yes, we've got to improve financial resilience, but we need a more adaptable price cap that changes more frequently.
And how soon does that need to come in? Because if we look at the long term, so the price cap's not a subsidy, it's just a control mechanism. Some companies are arguing they're subsidising customers just now because they're not able to charge the actual costs. So they've got to recover that cost. That would seem to me, one, prices are going to keep going up via the cap mechanism. These companies need to recover that. But what needs to happen to stop more companies going bust? Or other companies, is there a risk new entrants come in? When prices go low, you get a new entrant comes in and they can actually hoover up customers by offering a lower tariff, and then you've got further market distortion.
Absolutely. So I mentioned, I think earlier on, that there's a problem when prices go up, but if prices come down very sharply, then we are proposing introducing what's called a market stabilization charge, which would make sure that if you've done the right thing, you've hedged against your customer book, you've made sure that you're protected against prices going up, you don't simply lose all of your customers very quickly and then get into financial trouble. So that is one of the things we're yet to finalise, but we are considering.
So on one level, that stabilises the market and protects some companies that are losing money, but the flip side of that presumably is it's another charge effectively that consumers are going to have to carry, which confirms that we're going to be paying the result of this price spike for a long time, surely.
Well, look, I think the way the charge is designed will make sure that there are good value tariffs in the market, so people will still be able to access to quite significant reductions if the wholesale price allows that to happen. But it does attenuate that just for a short period of time to make sure that the market gets into a more stable position. As to the overall trajectory of price, with all of these factors, the main and most dominating factor is going to be what happens to wholesale prices. And that, we know what the forward markets are telling us, but I wouldn't rely on that as a good guide.
Okay, and just on that kind of resilience in the market prices, should there be greater regulation in terms of buying from the spot market, and making more companies hedge properly?
Well, Neil might want to come in on that, but basically my answer is yes, but yeah.
Yeah, absolutely. So we monitor the hedging levels of all the companies in the market. We're increasing our monitoring over that through the financial resilience work, and we will keep a close eye on what companies do. And clearly, the decision that a company takes, if they choose not to hedge, they need to have the capital adequacy to be able to withstand the shock in the market to protect consumers in the long term.
So I suppose,
what can you do as a regulator, though, if you now think companies X, Y and Z have not got enough long-term hedging properly in place? What can you do as a regulator then?
Look, I mean, we have a series of enforcement powers. So just to step back, just to reinforce what Neil's saying, so that's quite an important point. We don't want to get involved in the details of what a company does to manage its risks. So if they hedge, then that's fine. If they hold capital and they can manage it through a series of scenarios, that's fine. But they've got to do one of that or the other. What they can't do is not hedge and have no reserves to be able to cover it. And that's the important point of where our financial stress tests will take us. If we find companies are not where we'd like them to be in terms of risk management, and Neil, you may want to talk about what we're doing in terms of the governance around this as well. It's not just about what they do, it's about how they run their decision making. Then we have a series of powers to stop that. That would include, for example, starting with stopping a company taking on any further customers, so making sure they can't bring other customers into that risky situation. And it goes through dividend lockups and other mechanisms we have to make sure that before shareholders get paid, companies are making themselves more financially resilient. Now, what I expect to happen is I doubt we're going to find from these stress tests that everyone's perfect. I suspect the next stage will be a transition plan agreed with each of them to move into a different state.
That kind of goes back, to earlier questions to the Chair as well then. So if you find companies you don't think are resilient enough now, looking forward, there's still a concern even that if there's consumer credit, they've got their hands in that consumer credit and that's not protected and you still can't do anything about that with your current powers?
Well, what we're proposing is we introduce the powers to ring-fence credit balances, but that's why we are looking at not only ring-fencing them, but making sure those are insolvency protected. So you don't end up with credit balances that are held and then disappear as a company goes.
What's the timescales for the new regulations?
We're bringing those proposals forward in March.
Right.
Thank you.
Just to add to the point on financial regulation, we're also looking at the management frameworks that companies have in place over their organisations to make sure that they're managing these risks properly. So that involves things around governance, the process, the controls they have in place to satisfy ourselves that it's not just about whether they can handle the stress test, whether they've got the processes and the control in place over their organisation to make sure they can manage these things going forward, because they need to be resilient to a range of scenarios, price rise and price fall moving forward.
And Neil's from a retailer, so he's able to help us with that.
Thank you. Mark Pawsey, please.
I just want to go back on this resilience. I mean, if you're going to strengthen it now, by definition it was wrong before. Why was it wrong? Was it wrong because you got the parameters wrong, or were you being persuaded by government to let all these entrants in to provide some competition? We heard accounts of people setting up businesses in their bedrooms. I mean, that was just completely wrong. And so where did the responsibility for this lie? With Ofgem or with government?
So look, I think, ultimately, GEMA is the decision-making body for Ofgem, so GEMA is where decisions are made. And I have looked, as you can imagine, in detail at all the papers that came through and all the arguments that were made, and there was a clear ambition to diversify supply. Now, I think, frankly, that wasn't just a GEMA or an Ofgem ambition, that was an ambition that was shared with government at the time. And for example, there were quite a number of exemptions.
It seems to be let's allow anybody into the market at any cost. I mean, anybody seemed to be able to do it.
And we did introduce tests that applied to new entrants, and actually those tests have been quite successful in reducing new entry, but there was a time when a large number of people were coming into the market because Ofgem's focus really was on allowing diversification. Now, there were good reasons for that.
In hindsight, you'd have done something differently.
So with hindsight, we'd have done something differently, yes.
Okay, thanks, Chair.
Richard Fuller, please.
Thank you, Chairman. In your 2021 report, you say there are two equally important challenges. One is, quote, to protect today's customers to make sure they get a fair deal. How does Ofgem define fair?
So, one thing that has been really, actually increasingly clear to me throughout the crisis is we have to be really clear about our role. So by fair, we mean a price that fairly reflects the costs the companies have to pay. So what we need to do with the price cap is give our best assessment of what that costs. And when I think about what we had to announce last week, when I think about the scale of change, I know that doesn't feel fair to customers. I'm sure it doesn't. But our job, my team back in the office describe it as bean counters, is to make sure that we provide a fair assessment of what customers need to pay for their energy. What we can't do is get into value judgments around that, and ultimately that's not for us.
So essentially your definition of fair is that it relates to costs and a fair return on top of costs for your suppliers.
Yes.
Thank you. I was struggling in some of your answers to think whether the world would be better off without Ofgem. And it sounds like you're a regulator that's good for benign times and you're good for long-term transitions, but you're rather struggling at the moment. Is that a fair assessment?
No, I don't think it is. I think the work that Ofgem did through September and October, not only to protect customers, not only to move those 4 million customers to make sure that they are protected on the price cap, that they have supply, that they do get their credit balances back, and in addition to that, reforming the frameworks that we need to reform, means I think we've moved incredibly quickly to respond to the crisis that we've seen. Now, as I've said here, there are lessons for us. There are lessons for us, particularly in the way we set the frameworks up in the past, And there were judgments that we made that I think with hindsight we'd make differently. But we have moved extremely quickly in a situation which is as big as the oil shock was in the 1970s to make sure that we manage the best way through it.
So what are the consequences for those bad calls for you and your colleagues?
So in terms of...
Well, you just listed, I think you talked about, you made the wrong call on prices in May. You wish you had moved faster when the price cap was introduced. You wish that there had been tougher financial regulations. You've made assessments of £200 million that have been lost, admitted you'll get it back to customers. I'm just asking, you're the regulators, and between the top 5 of you, you rake in £1 million a year and you have £2 million of cash benefit in your pension funds. You've talked about fairness. I'm wondering, what are the consequences for you and your team for these bad calls?
Ultimately, our performance is assessed by our board, and that is something we're answerable to our board, Gemma. But a lot of these calls were made some time ago and certainly weren't under the decision-making of the people that sit in front of you today.
So generally your thought is you can't really see a reason proactively to suggest that you've done a poor job and something should be done.
I think that we have definitely we've got lessons to learn. I've been really clear about that today. There are things that need to change. But overall, given the scale and the pace of what we've seen, given the challenges that Ofgem has faced, we have made significant changes. We've protected customers and we're building the frameworks that we need to build, as well as doing the other things we need to do for the long term and for everything else.
Thank you, Ms. Braley. Thank you.
Thank you. Just 2 final questions from me. In respect to the £200 rebate and repay that we're all being forced to take on our energy bills, what role is Ofgem going to play in regulating that mechanism?
So, as you can imagine, there are details to work through, but particularly our role will be to make sure that those payments are made. So once the money is transferred to suppliers, our compliance teams will be working with them. Neil, I don't know if you want to sort of add anything further to that.
Yeah, absolutely. It's really important that we think through the detail with government and make sure that the mechanism enables money to get to as many consumers as possible, but also that we manage the risks. This is a significant amount of public money, so it's good for consumers, but we need to manage the detail working with the industry and working with government.
And it's mandatory. I don't want it, but I'm going to get it. That's right, isn't it?
Yes, that's right. It's a universal point, but that's really a question for government and not for us.
And on timescales, just remind us, when is this coming into force?
The payment should be made in October, according to the government scheme, and the details being worked through with the industry as we speak.
So when will we get sight of the details about how it's going to work?
Again,
just to jump in, I think this is all for government.
Yeah.
This is their scheme. We are helping them implement it.
Oh, but you surely have a date that you'll know when we're going to see the details of the scheme, if you're going to have oversight of it.
So we are.
Yeah, the scheme was announced last week. Plans are being made, but government will be in control of the communication timetable, not us.
So all of these details, I'm sure ministers will be really keen to answer.
I'm sure they would. Thank you, Mr. Brearley. So that brings the first panel to an end. Thank you, Neil Lawrence, Jonathan Brearley and Neil Kenwood for your contributions this morning. We're very grateful. We're now going to move on to panel 2. And physically in the room, we have Emma Pinchbeck from Energy UK and Stephen Fitzpatrick of OVO Energy. And then hopefully on our screens, we will see Peter Smith from National Energy Action and Jonathan Marshall from the Resolution Foundation. Just let the handover take place. Oh, good. I can see Peter and Jonathan. Good. So, thank you and good morning to all of you. So just to open with some questions from me before I bring in colleagues in the normal way. Emma Pinchbeck, if I might come to you first. We've obviously heard about the role of the change in the wholesale price of gas and how that's driven a lot of the issues in the crisis. But there's been lots of issues raised or concerns raised about bad corporate behaviour, whether it was about using consumer credit as working capital, unacceptable levels of risk on hedging, too low a level of capitalisation within businesses, and also the other roles around trying to undercut on pricing and auto-switching and how that maybe fueled some of the collapses, and ultimately the significant cost that consumers are now bearing for corporate failure, but also for a loss of, we anticipate, £200 million of consumer credit money that was consumers that has got lost in this process that they are now having to pay back themselves. Why was there this bad corporate behaviour in the energy market?
As you say, by far the biggest contribution to the rise that we're talking about in April is the wholesale gas price crisis, and that being passed on in the UK as it has been in other markets. When I gave evidence to you in September, we flagged that we had been worried about the retail market for some time as industry and been calling on the regulator for reform on many of the issues that you've discussed. We've had 27 retail businesses fail, and that has had a cost to customers. You can see that also in the price cap announcement. So we're working very closely with them on their proposed action plan. We welcome it. There's a lot of detail in it, so on each of those issues there are different views in the sector, but I think the important thing is we all agree we need a sustainable retail market that's fit for purpose, that offers fair services to customers, and fundamentally for this particular bill rise, the significant proportion of it is to do with this wholesale gas price crisis. So, you know, there's bad practice in every industry. Where there's been bad practice, we acknowledge it. I'm thankful that very few of the truly bad actors were not Energy UK members, and we have been flagging risks in the sector for a long time. A reset on retail is really needed.
If you were flagging risks for a long time, why do you think the regulator and or government didn't move more quickly?
I think there are a few reasons, but I'd start with this. I've been working in the sector for 10 years, right across energy policy, and I came back to retail 2 years ago. And a really big contributing factor is actually cultural. We don't understand what retail is for. It's often a very defensive or punitive relationship between the regulator and government and the sector. Some of the policies then that led to were things like, you know, push for more market entrance at whatever the cost, or a focus on collective switching, which often worked against the government's stated ambitions for things like net zero, which require enduring relationships with customers and good service. And so I think it starts with having an idea about what retail is for, seeing it as part of your energy strategy, valuing it, and then designing policy off it. And we can talk about, you know, some of the details and the mistakes. I think fundamentally what was very welcome is both the Secretary of State and the regulator coming out and saying there's short-term reform needed to get through this moment, but also we do need a much longer-term look at our retail strategy, and the industry will work with them on both of those things.
You welcome the suggestion from Ofgem just now that there'll be a closer working relationship between energy companies and the regulator.
I think it would be very helpful to have that cultural reset, yes.
Thank you. And Stephen Fitzpatrick, do you welcome that suggestion from Mr. Brearley that there's a closer regulatory relationship, supervisory relationship between Ofgem and energy companies like yours?
Yes, it's something that, I mean, we've talked about the business failures through this big increase in wholesale gas prices in 2021. But there has been more than 50 energy supply failures going back 5 years. So it's been pretty obvious for many years that the quality of companies entering the energy retail market and their ability to manage the complexity and rigour that the energy market requires just hasn't been there. I noted Jonathan Brearley's points about the support for more choice for customers and for the retail market to be more competitive. But I think it's pretty obvious that standards were lowered too much and that maybe enough attention wasn't paid on who was entering the market. So we have been calling for the standards and regulations to be tightened and for there to be a more collaborative relationship with the retail sector. I think Emma's point is correct that culturally, I think back to when I launched OVO in 2009, 6 ex-monopoly companies had a 99% market share and were extremely profitable. Fast forward 13 years, the market is very, very different. It's completely changed. But I think the relationship with government and the relationship with the regulator has become very, very difficult. So I welcome the reset. I think we're left with a relatively smaller number of, I hope, better run energy companies. They'll be able to invest more in the kind of technologies that we're going to need to help consumers make the zero carbon transition. There's going to be more responsibility on our part. I think it's clear that Ofgem want to see or want more information from us. We welcome this more transparent relationship. And I think if we design the market system right, then we can have fewer participants that are better equipped to support consumers. So I think it's all very welcome, but obviously more could have been done sooner.
And does OVO Energy ring-fence customer credit?
OVO Energy, in fact, is in a position where on a net balance, customers owe money to us. So we have a large number of customers that pay in arrears, we have some that pay in advance, and throughout the year, the cycle changes because consumers tend to, on direct debit, pay over the summer, they get to a credit position. Those customers that are paying in arrears, obviously they don't. And so on balance, we have a net, we are a net, not receiver, sorry, we don't have a net credit balance, we have a net debtor balance for customers.
That was a nice try, but you didn't answer my question. So for customers that are in credit, do you ring fence their credit?
No, all of our customer balances are in one.
So you don't? Okay. And you might have heard just now that Mr. Brearley from Ofgem said that he felt executives of energy companies should be liable in circumstances when there is failure. Do you agree with that?
I think certainly if I look at the failures that we've seen, I think there has been a lot of arbitrage opportunity where, and I know members of this committee will express their displeasure at this, but where there has been an opportunity to effectively gamble with other people's money, and in some cases consumers' money. And so where there has been inappropriate behaviour, I think it's absolutely right that there should be a redress.
And there was an announcement from government recently around tax changes to selling parts of companies where they provide different corporate structures between the retail side, the trading side and other parts of the business. What's your reflection on that?
It's part of a broader suite of measures that Ofgem and BEIS have brought in to tighten up how the retail market works and ensure that consumers and the taxpayer is better protected. And we've seen in some of the supplier failures going back to, I suppose, August, September, where there has been this segregation of assets, and unfortunately it's meant that the taxpayers ended up, or consumers have ended up paying more. So again, we welcome, and we're on the record of this, we've been speaking to Ofgem and BEIS throughout the autumn and the winter period, particularly over the Christmas period when we saw this really big spike. You heard Jonathan Brearley talk about 450 pence a therm. There were many scenarios where the entire energy retail sector looked at risk, and we were in discussions with the government about that. This particular measure, I think, is absolutely as it should be.
And so in OVO Group, I think I'm right in saying, you'll have the retail business with your call centre staff and selling energy and billing and all that type of stuff. Have you separated out your assets in OVO Group using different corporate vehicles in a way where this tax might bite if you were to try to sell?
Going back to 2009, we set up a gas licence company, an electricity licence company, and a group company. We also have an FCA regulated entity that provides insurance for consumers and so on. So yes, we have that structure. Our trading partner Shell is part of a broader credit group. The whole entity is secured against our trading relationship with them, which has given us access to all of the hedges that we've needed. And of course, when you look at other companies that have not had that structure in place, that have not been able to hedge properly, they've gone out of business very quickly. So for us, it's enabled us to hedge properly throughout the whole winter.
Okay, thank you. Alexander Stafford, please.
Thank you very much. This is mainly to Peter and Jonathan. So we know about the high impact of energy bills, but I'm more interested in what those high impact of energy bills have on actual household budgets. So what are you seeing people scrimping, saving on, sacrificing, and what impact is that having on people? So maybe Jonathan, maybe first.
So last time that energy bills increased to a sort of similar proportion of household expenditure, when back in 2014, when fossil fuel prices were very high, we saw households, particularly those at the lower end of the income distribution, cut back on social spending, so cutting back on going out to the pub, going out for dinner, going away, and there's a reasonable chance that could happen again this time, and that would be in terms of the timing and the way that sector is faring up through the pandemic, that would be quite damaging, because you'd see businesses that need support having money flowing into them fall, because that money would then instead being spent on energy. But what of course is different this time is the presence of the price cap, and therefore the overnight nature in which this bill increase will happen, that it will be much more of a shock. So when energy prices increased from say 2011 to 2014, they did so slowly, people moving on and off fixed tariffs, that sort of thing. Whereas now with such a large proportion of the country on the price cap, this bill increase will be happening so quickly and so overnight that spending being reduced in other areas is likely to be on other non-discretionary items such as bills and things like that.
Okay. And actually, just before you come in, Peter, picking up on your point, Jonathan, I appreciate your point saying that obviously people spending less on going out and leisure will have an impact on the wider economy. But I think it's safe to say a lot of household budgets have already cut out quite a lot of going out, let alone foreign travel, because of the pandemic. So would you say there's already more money in the pot, so people take away from that, so we actually lessen the impact, or do you think that doesn't make a difference?
I mean, that was just a comparison to what happened last time bills were so high. So obviously, it's hard to there's no sort of official data around for this time. But this is if for the average home to go from £100 a month to £150 a month overnight, this will put immediate pressure on spending. So it's not a pleasant state of affairs for those on lower incomes and with lower levels of saving.
Peter.
I think just to add to that, I think we certainly represent the interests of low-income and vulnerable consumers, and we've got an aim as a charity to ensure that everybody's able to afford a warm and safe home. Sadly, despite welcome progress over a number of years, that vision's now in serious jeopardy and never been further out of reach in time. And we know that the people that are going to be hardest hit by these recent increases are those people living on the lowest incomes and least efficient homes. The trade-offs that people will be making, you're absolutely right, are related to essential goods and services and foregoing those. People used to talk about being the choice between heating or eating, but it's getting to a situation where people won't be able to do either satisfactorily. These are going to have these rises are going to have massive impacts on the poorest households, and are going to be not only decimating their finances, but their health and well-being for a long time to come, sadly.
And I think, Peter, the NEA, the stats have said that the number of households in fuel poverty at the end of last year increased about 4.5 million, and this projected rise in April results in 6 million customers now in fuel poverty. That's correct. Can you comment on those, please? But how do you think the fuel poor and those at risk of fuel poverty should be best supported? What is the solution at the moment?
Well, overall, those figures are actually more conservative than they now are, given that we know the scale of the increases. So, sadly, we think that there's now going to be 6.5 million UK households that are unable to adequately keep themselves warm and light their homes, sufficient for their own well-being. That doesn't take into account some of the positive impact of the government's proposals that were announced last week. Very strong reasons for that. We don't believe that the poorest households are likely to benefit universally from a council tax rebate. Millions of households are exempt from those council tax in the first place, and obviously this Heat Now, Pay Later proposal will need to be paid back. So we haven't discounted those numbers for those interventions. I think in terms of a policy response, we're still bitterly disappointed that the UK government hadn't honoured their previous commitment to ensure that any interventions in this space would particularly look to better support those households that are on the lowest incomes or in the most vulnerable positions, who obviously get hit hardest by higher energy price increases. And in response, hopefully we'll get into a discussion about what the regulator can do. But first of all, we need to fix the support that has been confirmed. There's a genuine risk that those households that are on older legacy prepayment meters, for example, might not benefit as much from a rebate, and it would be more difficult to apply that rebate to their energy meter. And in addition to that, we've got to ensure that the compensatory mechanism to recover those costs is as fair as it can be. We would strongly urge the government to consider enabling low-income and vulnerable households not to pay back the cost of that upfront support. And there's mechanisms in place which would enable a form of exemption to apply to those households. But certainly, if we don't do that, we can't default into what has been the sort of business as usual method of recovering these policy costs, which is through in a flat way, recovering it on everybody's bill, irrespective of their income, payment type or energy usage. That would be the most regressive form of cost recovery, and we would strongly urge them not to do that.
I've listened carefully to what you just said, but most of your solutions seem to focus on what happens on the pay back on money rather than helping people on 8 in April. Can you talk a bit more about exactly what the government should be doing now, rather than worrying about the paying back, what they could do now to help out? And also you talked about the people in prepaid meters having difficult to have the rebate and the things applied to them, but I think previously the government had sent QR codes in the post. Why do you believe it's not going to be as good for people on prepaid meters?
Well, first of all, we have been advocating an urgent rebate, which can be taken directly off the bill. We believe that provision should have been much deeper for the most vulnerable households, and there's still the opportunity to do that if there was a rethink in government. Second of all, we've been highlighting existing mechanisms like extending winter fuel payments to other low-income working-age households that are eligible, for example, for cold weather payments. That's about 2.4 million UK households. It's not just in GB where the current support will be targeted, but across the UK, which could benefit from a payment of £300 as soon as that can be done. There was also a lot of rumours that the government were going to be extending the warm home discount scheme. Sadly, we don't think that mechanism has been adjusted or at all, really, from the consultation proposals that were released last summer. So obviously prior to the energy crisis, and just making more people eligible isn't going to be an adequate form of response, because essentially more people are going to be competing for fewer resources. Sorry, you mentioned the second part of your question. If you wouldn't mind repeating that'd be great.
About prepaid meters, you said it'll be harder for them to get the rebates. I think in the past the government sent things like QR codes in the post. And why do you think it's going to be harder for people in prepaid meters to have those benefits this time?
Well, thank you. So essentially, there's about 4.5 million GB prepaid customers. About 2 million of those have smart meters, so they should be automatically able to sort of net the money off automatically. So we're less concerned about those. But for those households with older legacy prepaid meters, when previously the government undertook this type of exercise under the government electricity rebate, there were challenges trying to redeem vouchers for customers that are on those older legacy prepay. It will require some bespoke form of communication and hopefully a campaign and active channels of advice to encourage those households to take up that support or redeem those vouchers. I think that from memory there was about a 10% fallout, so even on those figures, which are pretty generous, really, because it was only a £16 rebate last time, happening over 2 years. This is a much bigger rebate happening over a much shorter period of time. Will mean that those households are in about 250,000 households could be at risk of not being able to adequately redeem the support that the government is making available. And the challenge there is compounded by the universal collection mechanism that I mentioned earlier in terms of the levy. So whilst there's doubt and uncertainty about how all households' ability to be able to access the £200, there's grim certainty that if we sort of plod on and just apply this £50 levy in a very blunt way as the cost recovery mechanism, they will undoubtedly be hit by those costs, particularly through standing charges.
And just to focus a bit more back on the prepayment meter customers, because I think they're going to see the cap limit going to sort over £2,017. First of all, to you, Peter, what extra support for the prepay meter customers should be? And then I'm going to bring in Emma, if that's okay, to discuss prepaid meter people. So Peter.
Certainly. Well, essentially, we strongly articulated our concern when Ofgem made a decision to remove the previous bespoke form of price protection that there was in the market covering prepaid customers and merge it with the wider default tariff cap. that has had a clear and negative impact on those customers, probably in the region of between £60 to £100 per prepaid customer in terms of the difference between those two forms of protection. We know that those households that are on prepay are going to face the biggest increases in cost as a result of the rises that are increased. Overall, about £200 million more from April over the course of the year. So a massive amount of extra money that PPM customers are going to be facing, despite the fact that they're already in many instances in significant debt. So we would like to see the Ofgem work with the UK government to investigate the case for a much stronger form of protection, particularly for the poorest prepaid customers, and investigate a new form of protection in the form of a mandatory social tariff, which we think would offer low-income households an opportunity to be protected in a much deeper way than the current price protection works in the market.
I think Pete has admirably covered many of the issues, but I'll just add some evidence to what he said. Firstly, Alex, if I may, in terms of the impact, some figures that we've looked at about how many households this affects. If you're just talking about the price cap change, it's worth noting that more people are on price cap tariffs because of the changes in the market. So we think it's now about 22 million households affected. That's up from 17 in October. So more households impacted by the price cap rise. In terms of looking across the economy and spending, it's an industry statistic, and it is, I will admit, my back of the envelope maths, but basically we assumed that bills of around £2,000 work out around 7 to 10% of even the median household, according to the ONS, of £29,000 a year-ish. 7 to 10% of their disposable income will go on energy costs now. So it's a sizable chunk of what is a wider issue, which is why we were saying there has to be a government role here. This is bigger than just energy. It's a whole economy issue. In terms of fuel poverty, and PPM customers in particular, we've got 2% more people on the priority services register. We can already see that in industry, so we're seeing more inquiries coming forward, more people in fuel stress. So the fuel poverty issue is getting bigger too, and Pete's updated and terrifying figures, about 6.5 million homes in fuel poverty through this period. And as you've noted, a lot of the support is due to come in October, so we can expect those impacts to run.
On that point, do you agree with Peter's uplifting of from 6 million people, 6 million households in fuel poverty to 6.5 million? So that's quite a big extra increase than projected.
I haven't seen his figures, but I'll check them after.
But is that sort of number that you are thinking? You're
we
seeing
had 6 million down, and that's consistent with kind of previous rises. And again, if you think about that number and the amount of disposable income we're talking about for the median households, that seems more than plausible to me. And again, we were raising these points with government in the run-up to their announced relief, that the issue is just bigger across the whole economy, more people in fuel poverty, more customers affected, and so on. In terms of targeted support, we've always said that vulnerable and fuel-poor customers should be the priority. We got the detail of the announcements at the same time as everyone else, so we're working through things like whether this is the most effective way to target it, whether it's enough. I think, in short, there's a rebate piece and a spreading of costs piece, questions about how quickly both can be brought in and how well targeted they can be, which is for when we've looked at the detail, and we're working closely with the regulator and industry on the detail. Other things that could be done, there was a long list of solutions that we proposed. There's still options available. You could move VAT off bills, you could keep the policies but move policy costs into taxation in the long run. We know that investing in energy efficiency in the long run will also help fuel-poor households in particular. You could, as Pete says, go beyond what the government had already consulted on with the warm homes discount and so on. For PPM customers, the issues are the ones Pete raised there. There's a higher cost to serve them administratively, which Stephen might have more detail on, but that's why there's a difference in the price cap. In terms of what would help, more of those households having smart meters definitely helps, and that will help them get the rebate. And in terms of what we're after as industry, we want as many vulnerable customers to get support as quickly as possible. We've got the detail at the same time as everyone else. So for homes like prepayment customers, things like rural households, business customers, there's either a gap in support or we're working through the detail to see how they can get it. But we can follow up in writing as those details come forward.
I'm actually quite pleased that you've given a positive message for smart meter for once, actually, people, which actually is what the industry is struggling with for many years. Just briefly, one last question, Chair. Peter, I think, was quite damning, about the government support and the new government policies, and critical about it's not really helping the right people. I know you're still working through your numbers, but when you've seen what you've seen already, would you be critical as Peter, or you still? What's your view on it in a sentence without looking at all the numbers?
Not looking at my numbers. So having been calling on Treasury to act, I think there's been a huge shift in government between where they were in September and now, in that I don't think that the government originally thought that there was a role for them in supporting customers, and the scale of this price increase and what it means for the economy and for householders has become apparent, and they've moved, and that is a good thing. No one in the industry, having called for government to act, is going to knock the fact that they have, and particularly that it was the Chancellor and Treasury that has moved. Overall, if you look at the boxes ticked, it's the right sort of approach in that they're trying to look at, acknowledge it's a whole economy problem, deal with inflation by looking at median households, and try and do something for fuel-poor households in particular, and try and bridge the gap with the local authority fund they're putting in place. There were other things they could do and could still do, and I think the message is it's good. We, as I said, as industry, got the detail at about the same time as everyone else, and the devil is in the detail of how effective this is. For all of those groups I discussed, there are some gaps, business customers being one, and lastly, a lot of the support doesn't come into October. For industry, we see this as a bit of an enduring crisis, and I think it's going to have to stay under review, both in terms of what the details mean and in terms of whether this crisis continues. It was really welcome to hear the Energy Minister say exactly that. So that's our take as now, and we're going to keep working on the detail with government.
Thank you. It's good to hear that you're not as critical as Peter, and of course, it wouldn't be your job unless you want the government to go further and more.
Thank you. Tonia Antoniazzi, please.
Thank you, Chair. I'm going to go with an extra question for you, Emma, actually. I mean, we've just seen this morning eye-watering profits being made by large oil companies. Would you welcome a windfall tax, and would this go some way to address the problems that we've got now?
So, on windfall taxes, what we were saying to Treasury about if it's about covering the costs of these proposals, the first thing to note is the case we were making to Treasury for intervention was around the inflationary risks of the economy. So the previous energy price rises were worth about 1% to 2% on inflation. We think that the same again with the price rises coming, and the same again with the price rises coming in October. 1% to 2% on inflation, again, my back of the envelope maths is about 10 to 20 billion of government debt, because of the way government inflation works. So we felt that there was room, just by avoiding the cost of inaction, to take action to support householders. In terms of windfall taxes more generally, I look after the energy suppliers and the people who build infrastructure in the system. The energy suppliers made a negative margin. It's part of what we've been talking about here over the last few years. And then on the generation infrastructure side, the Committee on Climate Change says we need £50 billion a year to deliver net zero, most of which will be private capital. They're only talking about 4 to 6 billion coming from the public purse. What we've seen from windfall taxes on generation infrastructure in particular is that you scare off investment, and we've seen that in some of the markets where they brought windfall taxes in. So for us, with our agenda, firstly, we need a stable supplier market. We wouldn't be suggesting windfall taxes there. There isn't money. That's why we're in this mess. On the wider case, any windfall tax that affected that massive investment needed for net zero would be a real problem for our members.
Thank you. I'm just going to go back to Peter. You're not Neil. Neil was the previous gentleman. And Johnny. I apologise. You've already touched on this, Peter, quite a lot, but I just want to go to Johnny and see what he says. Do the measures announced by the Chancellor of the Exchequer on the 3rd of February adequately support households, particularly the vulnerable and low income? And while we probably know, what we've already heard today, if it doesn't, why doesn't it?
Thank you. So there's sort of three top line takes of the announcement last week. One is how much money is made available, and it's clear that, you know, for low-income households, even if they get the full level of support, so the £200 sort of discount and loan back, and then the money through council tax, that only offsets about half of the bill increase. So there's no other way around of saying that's just not enough money. That's still a huge shock for energy bills. The second point is, who gets it? The rebate for everyone is a very universal approach, and the method of delivery through the council tax system is also very universal. We think only about 20% of households will miss out on the extra payment through council tax, because the vast majority of homes are, A to D rated, and those that do miss out will be in areas where property prices are more expensive. So less than 1 in 10 households in the northeast and northwest will miss out, compared to more than 3 in 10 in London and the southeast. But within that, there are a number of households who are on low incomes, but in high value properties. If they don't own their house, for example. So, the lowest income decile, more than 1 in 10 of these households they'll miss out on this rebate, and that adds on top of people who will miss out on it through other means as well, such as potentially how you pay for council tax. If you don't pay for your direct debit, there seems to be a lot of uncertainty at the moment about how that money will be given to you. People who don't pay council tax themselves, so students, for example, or people who move housing situation and during it, so people who move in and out of parental accommodation or in and out of cohabiting or shared houses or things like that, they will also miss out. And then the third point is how it's funded, which is agreeing with what Peter said earlier, is using basically loaning people, making people take on a loan to pay their energy bills isn't a particularly sustainable way of doing things. If energy prices stay elevated, it's going to be an additional charge on bills for years. One of the things we were looking at before was delivering a similar rebate in terms of bill discount by funding the levies part of bills through taxation pending a review. There's supposed to be a government review of how these are going to be funded in the longer term. But we looked at if you could pay for this, which is about £180, £190 for a household with average energy consumption, pay for that through taxation, which would mean that the households didn't effectively build up a debt on their energy bills. And then you could revisit that situation through this impending energy fairness review and see if that was the right way to do what is both a means of paying for these things more progressive, but also a vital step in decarbonising, particularly domestic heat.
Jonathan, to what extent then is it concerning that the support package announced by the Chancellor doesn't set out a plan for the medium term, particularly in the likely scenario that we're going to see another energy price cap, raise in October? And what could the government be doing now to mitigate the impacts of a rise in the energy price cap in October?
So all the plans seem to be based on the idea that energy prices will wane going into next year. And there's, as a representative of Ofgem was saying earlier, predicting wholesale markets is incredibly difficult. So if these prices stay high, that will highlight the fact there's no sort of medium-term element to this plan. And there's also, you could look at more sort of structural changes to the system. So changing the way that the sort of electricity system works, how electricity is generated, how gas sets the price, despite a lot of electricity not being generated from gas. You could look at how dependent we are on gas in our homes. So start to accelerate whatever programs can be done that wouldn't be overly hasty to try and particularly shield lower income households from energy costs. So, for example, the energy company obligation scheme, which is ramped up from April, that could be potentially amended to speed it along a bit, to sort of front load it. And there's also, there's within the electricity sector specifically, there's if prices do remain elevated through gas, there's also a couple of other factors coming down the line. Our sort of nuclear power station fleet is getting pretty old now. We've seen a number of power stations announced they're going to be closed already, and then there's no plan for what happens if Hinkley B closes. I think that's planned to close this year, and then there's 2 more power stations set to close 2024, that will all increase the electricity system dependency on gas in the medium term, for which there's no plan as part of what the government announced to reduce that and to shield households from what could be high energy prices for the long term, or even higher if various geopolitical events continue to look like they're going to happen.
Thanks, Jonathan. Peter?
Can I just underline that we take absolutely no pleasure in being critical of the UK government or Ofgem's handling of this crisis. We would have dearly loved to row around exactly what the government had said they were going to do, which is to provide more protection and more support for low-income and vulnerable consumers as the priority. So I just want to underline that point, that we're not in permanent opposition to what the government's doing, and we will try and work proactively. And we were engaged yesterday in the call from BEIS about how this new heat now, pay later mechanisms will work, and we'll engage on that detail. But there is not going to be any direct support to reduce energy bills until October. So there's going to be a gap from when the prices go up massively in April right through to October. Yes, some shielding from council tax rebates, but I've mentioned that doesn't directly address energy costs or present value to those people that are currently receiving relief from council tax. So there is going to be a huge hiatus. That's going to need to be responded to. That surge in demand of people needing support is going to need to be responded to. We're, as well as an advocacy organisation, an organisation which delivers direct support to low-income and vulnerable consumers, and we're gearing up for an absolute firestorm. We're already seeing huge surges in demand, and I think we've got to be honest in terms of our abilities as a charity. There's only a relatively medium-sized advice provider to be able to cope with the sort of scale of challenges and demand for our services that are coming down the track. And I know that is also the case for much larger organisations like Citizens Advice. So we do need to preempt that surge in demand, particularly for advice, but also for things like debt relief, crisis forms of top-ups for prepayment meters, because those hardship funds that are out there will run dry very quickly given this situation, and certainly current mechanisms aren't adequate to cope. I just want to underline one particular concern in that context, is that organisations such as ourselves and many hundreds of others are almost entirely reliant on warm home discount scheme industry initiatives as the key way of funding the majority of our activity to provide energy advice, to provide income maximisation measures, to provide debt relief, that type of activity. But it's very likely that there's going to be a huge hiatus between when we see the regulations, which we still haven't seen from the UK government, and when that support's going to be delivered. Again, likely to be in October by the time we even start signing agreements with energy suppliers about what type of support we need to put in place. That there needs to be some sort of bridging provision around that advice and support. Otherwise, unfortunately, we won't be able to respond to the huge surge in demand that we're likely to see.
Okay, thank you. Peter, can I go back with a question, Chair?
Quickly.
Yeah, okay, right. Sorry. Going back to the Heat Now, Pay Later scheme that you said you'd spoken to BEIS about, when that £200 comes out automatically in an equal 40 payments, instalments from somebody's account, what if that person is vulnerable and has never had an account before? Will that automatically come out of their payments if they're not actually receiving the benefit now?
I think it's probably too early to say yes, it will. But certainly the early indications that we've received is that government want to keep things as simple as possible, and that means recovering the charge in an equal way of £40 instalments over 5 years, and that money will just come off the meter every month, irrespective of who the occupant is or who the meter user is, which would be very regressive.
Thank you.
For supplementary, quickly from Mark Jenkinson.
Thank you. I just need to correct the record there, because everything we've seen from the department suggests that it will actually be, while it's out for consultation, will actually be an increase in standing charge, not any equal instalments of £40 in any way or being taken back at all. The fact sheet published on the .gov.uk website is clear that they expect it will probably be taken in an increase in standing charges.
Okay. Thank you for that point. Peter, there's no need to respond, so thank you for that. Emma Pinchbeck, I mean, there is a point here about the rebate not being targeted. I mean, I said earlier, for example, I'm actually in a great long-term fixed deal with my supplier. They're probably selling energy to me at a loss, which I know is not great for them, but it's fine for me. I don't want the £200, but I can't refuse it, can I?
And these are all, as I think Jonathan said in the previous panel, these are all decisions for government. And as I said, we're getting the detail in live time. So some of the points that Pete and Jonathan are making around, is the amount enough? How will it work? How will the payments be taken? Is it effectively targeted? Are all questions that get better or worse depending on the exact methodology and how they administer it, I think. And the other thing I'd say is we are going to keep pressure on government around supporting households if we need. In terms of you, Darren, and your energy bill,
that's
you
fine.
can also donate to the NEA and other fuel poverty charities if you feel you want to.
I would be very happy to, thank you. And very briefly, I'm conscious, Stephen Fitzpatrick, you've not had a chance to reflect on the government's announcements last week. Is there anything you want to add?
Well, like Emma, I would say we have been calling for the government to make a broader intervention to help dampen the volatility that we're seeing across the entire UK consumer group. I think it's pretty obvious that this unprecedented spike in wholesale prices is largely as a result of this big geopolitical situation that we have, and it's something completely outside of consumers' control. So the mechanisms that we've seen to dampen the big spike, I think, is welcome, not least of which because of the impact it would have on the inflation-linked cost to government. Is it well enough targeted? I mean, the numbers, I would say, tell their own story. The average bill a year ago was about £1,000. 2 million people were deemed to need £140 of help through the Warm Home Discount Scheme. The average bill has gone up by £1,000 and the Warm Home Discount has gone up by 10. And so it's pretty, I mean, those numbers tell their own story.
Thank you for that. Mark Halsey, please.
Thank you, Chairman. Just quickly, we heard from Ofgem about changes they're going to do, lessons learned, and we heard a bit of a mea culpa about how they'd allowed too many poor entrants into the market. Emma, were any of those 30 companies that failed members of your association?
So some of the early ones that failed were, but I haven't actually had that many members fail, with the exception of Bulb. It was a very big supplier and they were members of ours. So I think I semi-joked last time that in itself being a member of a trade body suggests a certain level of professionalism. And actually, I think that's true. The point here on the failures is that some of it has been found to be about bad actors. A lot of it has been found to be about the regulatory structure. And then on top of that, we have a gas price crisis, which is Stephen and others said is a global one affecting the markets.
But if they'd been a little bit more thorough, they might have prevented some of these undercapitalised companies going in and some of the problems we've seen. Do you accept their apology in many ways for what's gone wrong? And do you think that they actually are going to do what they're going to say and have a tighter control over players in the retail market?
Yes, as we've said for a long time as industry, we were concerned about that focus on as many market entrants as possible and on things like collective switching as the wrong measures for what customers wanted, and certainly the wrong measures for a stable market. So it is exactly what we were asking for when I last gave evidence to you, and in that sense it's welcome. We're working with them on the proposals. I think, just lastly, again, it comes back to retail being incredibly valuable in the future energy market we're trying to build, and we want to see it prioritised alongside things like making sure we swap over to renewables in a sustainable way, making sure we build a more resilient energy system. The retailers are a huge part of that and bringing customers with them, and a more positive relationship where we understand what future energy services are and what consumers want is the world we need to work to. So all the short-term changes we're working on, the apology or the kind of the reset of the relationship is welcome. Government saying they're going to look at their long-term retail strategy is welcome. And in as much as we welcome the innovation in the market over the last decade, we recognise as an industry there was need for reform.
Okay, and in terms of price, they're looking at two things: price cap contracts and a change to a review quarterly of the price cap. Are those going to make any difference?
The more regular reviews of the price cap, and certainly looking at the methodology is a welcome step. We've all talked about the sudden shock to many consumer bills because of the price cap only being evaluated over 6 months. So that's a very sensible first step to try and smooth that. Then there are wider conversations about market reform and where we want to get, and the price cap is only part of that. Again, it's a very big industry with mixed views, but broadly I think we feel positively about what Ofgem are now trying to do.
Okay, and Stephen, have you got any thoughts on what you heard from Ofgem earlier today?
I think it's, as Jonathan mentioned, it's trying to find a balance between something that's simple enough that consumers can understand or have trust in, which is difficult. In something as abstract as energy, very few people, understand how the energy system works. So something that's simple enough that consumers can trust and have confidence in, but then it also addresses the fact that we are part of a global energy market and that there will be volatility. So finding a mechanism that will smooth prices for customers and give them transparency and confidence, but still allows for companies like OVO and members of Energy UK to effectively hedge, that's the right balance. And I think the quarterly price cap review is probably the most efficient way of doing that. But I think it's still under consultation, and there's a lot of dialogue now, which is really positive.
I guess you'd be happier to have fewer competitors.
No, the funny thing is, I don't think it's really a function of how many competitors there are. What we've seen in the past, where we had like 60, 70 different market entrants, very few had a differentiated consumer proposition, everybody competing on price, but at an artificially low price. And so you end up in a situation, it looks good for a little while, and then, as always, things that are too good to be true, they don't last forever.
You'd like to see this higher barrier to entry as well, then?
I would like to see more rigorous regulation, more expert regulation. I don't think it's necessarily a question of higher barriers to entry. If there's a company or a startup that thinks it's got an innovative customer proposition that's going to be valued by consumers, they should be able to enter the market. What they shouldn't be able to do is benefit from a working capital arbitrage where they can acquire lots of customers at an artificially low price, use customers' balances to fund working capital, and then end up operating at a loss for several years, go bankrupt, and owe consumers and the industry tens of millions of pounds. And we've seen that time and time again. So there have been other successful new entrants that have survived even the recent volatility. And we welcome the competition. We welcomed it in 2016 when the first solar happened. And we welcome it today. But it has to be something that customers value. It can't just be artificially low prices.
Okay, thank you. Thanks, Chair.
Thank you. Alan Brown, please.
Thanks, Chair. Just to follow on with questions for yourself, Stephen. So, picking up that, and earlier on, you were quite scathing about the quality of some of the companies entering the market. You seemed open to directors being held to account, but if you look at OVO's been fined £9 million from Ofgem for overcharging customers. At the moment, OVO's got proposals basically to get rid of 1,700 jobs, almost a third of the workforce, and the unions and the local members for Perth have been quite scathing about the fact that they feel you've not been engaging with them. So are you in a position to point out the failings of these other companies?
I accept there's a few different points you've raised there, so if it's okay, I'll go through them one by one. We received a fine back in 2019, I believe, for just over £9 million. It was mostly relating to an issue they had of underestimating consumption through one particular winter. And again, we've worked hard with Ofgem and tried to resolve all of those issues. I would say the issues affected a relatively small number of customers, and it was a relatively large fine. We've taken that, constructively, and I think we now have 40 people that work in our compliance team, and that's an indication of the kind of complexity and the seriousness that we take the regulations. We believe that regulations to protect consumers should be much simpler. We have hundreds and hundreds and hundreds of pages of regulations that we're currently trying to meet, and some of the regulations are in fact so complex they are impossible.
It's the regulations' fault rather than OVO's fault.
No, I absolutely accept it. We made a mistake. We accepted that at the time, and we accepted our responsibility, and we accepted the fine. In relation to redundancies, we've announced a voluntary redundancy programme a few weeks ago for 1,700 roles. To this is part of a broader range of measures that we've been putting in place to modernise and digitise the SSE business that we acquired in 2020. As part of that, to put things in context,
saying when you took over SSE Retail, was that always part of that forward-looking business plan? Was this digitalisation and shrinking the workforce by such a large number? And if so, did you make that clear when you took over SSE Retail that you were looking to get rid of a third of the workforce?
To put things in context, in 2021 we created 1,450 new roles. Many of them in zero carbon advice, new energy technology, software engineering, digitisation. So that's 1,450 new roles with an average salary of just over £34,000, so well above national average salaries. And as part of the digitisation and the restructuring of SSE, one of the things that was clear to us that the previous owners moved to offshore a lot of customer-facing roles. Was something our customers didn't want. They wanted to speak to somebody locally. So as part of this new measure that we announced a few weeks ago, as you mentioned, we're reshoring 1,000 customer-facing roles and hiring and spending £20 million on training for our existing and those new members to become experts in zero carbon technologies. So those are jobs that have been offshored that we're now bringing back. We're opening a new academy in Glasgow to build a centre of excellence for zero carbon advice. And so that's all part of the new pack, and it's part of becoming an energy company that's fit to help consumers with the challenges that they face in the future. In terms of the plans that we had when we acquired the company, 6 weeks after we acquired SSE, we were told by the government that nobody was allowed to leave their homes. The 6 weeks after we acquired, there were nearly 7,000 employees that we now needed to find a way for them to work from home. We needed to find a way to support consumers. We needed to find a way to support consumers with prepayment meters that couldn't leave their homes to top up their energy meters. It was nothing was as we thought it was going to be.
You did get government support in terms of £17 million job retention scheme. So
that was the furlough scheme. Yes, we had 3,400 people that were on the furlough scheme for just over 3 months. So that was in 2020. One of the things that we've found really clear, as I said, in the last 2 years that we've acquired SSE, the energy market is changing very quickly. The customer behaviour has changed unrecognisably in the last 2 years. Customers would now much rather speak to us on video conference and speak to somebody in the UK that they would rather call in. They would rather, and increasingly so, use digital channels. But we realise not everybody can and not everybody wants to use digital channels, and that's why bringing back 1,000 customer-facing roles to the UK is part of this package. I'd like to add, we increased the training allowance, a training budget for £20 million to help upskill members of our team to help advise consumers. We also increased the minimum pay across the OVO group from under £10 an hour to £12 an hour. So that's the whole series of measures is around, first of all, equipping our team to better advise consumers, investing in digitisation and low energy technologies, and investing in higher skilled, higher paid jobs. Now, unfortunately, as part of that, we do have a redundancy programme, and every single one of those new roles is available to the members of our team that have been offered redundancy.
Please. It's just, we've talked about reshoring. I'm sorry to interrupt, but there's also jobs being offshored within your organisation. So do you want to say a little bit about that, where they're going? How many jobs are being offshored? Because that's a real grave concern to the workforce.
On balance, we're bringing jobs back. Now, there are some roles...
Wasn't my question. Yes. So how many jobs are you offshoring?
I'll have to come back to the committee with that exact
number. Is it a net... You're talking about 1,000 coming back, but 1,700 redundancies. So is there a net workforce increase in the UK or decrease?
I will have to come back to the committee with that exact net figure. We are currently facing a massive skills and labour shortage in the UK. We have had hundreds of companies contact us to be put in touch with members of our team that have been offered redundancy, and on a voluntary basis, a voluntary redundancy basis. And we have more than, I believe, 2 jobs that we have been notified for other employers that want to hire these people. So we have increased the minimum wage, we're increasing training, we're helping the people that are affected by the redundancy program that have volunteered for redundancy to find other work. This is all part of a dynamic 21st century economy. I understand that the change is difficult for some people, but this is what a thriving, dynamic, digitised economy looks like.
Is that, I mean, another issue that's raised concerns is £40 million of loans that's went out from OVO into other companies that you own. So by default, customers are effectively carrying these loans that you're putting to other companies. But is that appropriate, these loans, and are you willing to share that information with the unions in terms of open and transparent books? That's one of the requests.
So I don't recognise any loans, and the number 40 million I read once, but I don't recognise that number. There is a brand license agreement between OVO Energy and the holding company that I set up, Imagination Industries.
If we were to write to you, or if I was to write you the chair, you'd respond about that information?
Well, this is a relatively common business arrangement with Virgin Group, EasyJet Group and so on, have exactly the same arrangement. Everything has been in place since 2014. It's all documented in Companies House. All of the funds are located in the UK. We pay tax in the UK, and I've used the money to invest in companies that are based in the UK that have created hundreds of jobs in the UK. And it's all completely available for anybody to...
But if I was to write to you with questions, you'd respond?
Of course.
Yeah.
Okay. Charlotte Nicholas, please.
Thank you. And just to come back on those questions from Alan, do you think that it's acceptable to take over £17 million in UK government funding through the Job Retention Scheme while making these redundancies? And in answer to Andy's question, I believe it's 183 jobs that are being offshored to South Africa. This is money that was given to your company by the UK taxpayer in order to protect UK jobs, something that you're not doing.
So in 2020, as we discussed, the whole of the UK economy ground to a halt, and we had this extreme uncertain situation. The government set up the furlough scheme to help preserve jobs in that time of extreme uncertainty. We had 3,400 employees that went on furlough. Every single penny of the money that we received from the government went to pay those individuals. And beyond that, as a company, we agreed and made the commitment that we wouldn't cap their furlough payments at the 2,500 government cap, so we topped up the rest on an unlimited basis. All of the directors and senior executives of the company at the time took a 20% pay cut and offered that money to individuals that were affected significantly by the lockdown and coronavirus. We haven't paid any bonuses for the last 2 years, and in fact now, all of that money that we received went exactly to the purpose it was for. As we move forward, as I said, we announced a redundancy program. It's a voluntary redundancy program. Every single person that's taken redundancy has opted to do so, and we've also, as I mentioned last year, created 1,450 new jobs. And so I understand why there's concern when people hear the word redundancy. But over the last 2 years, if you put everything together, we are investing in the UK economy, we're investing in skills, and at the time, as I said, the thing that the UK economy needs more than anything right now is talent and access to labour. There are massive labour shortages. Business cannot hire enough people. And we looked at all of that when we looked at the timing for this redundancy programme. We thought this is, if you're ever looking for a new job, this is the best time in a generation to be looking for a new job.
You're doing your employees a favour by making them redundant.
We've offered a voluntary redundancy program. We have a number of roles that, due to changes in consumer behaviour, due to changes in the energy market, these roles are they're not required. And so we treat everybody that's affected with respect and compassion, but we can't simply keep people on the payroll employed in jobs that are no longer needed. What we can do is offer them retraining and skills and offer them new roles or redundancy. And in many cases, employees have opted for redundancy. But again, this is part of the challenge that we all face is that we need to help consumers go through this transition to net zero. We need to run our businesses as effectively as possible. But the technologies and skills that we need to get to net zero are quite different from those that we have had in the years gone by. And so investing in skills training, increasing minimum wage, and I think I'd like to go back to that. At the time that we said, we are reducing the number of roles in the company, we made a commitment to say we only want high-paying jobs. And so we have lifted the minimum wage in our group by nearly 24%. And whilst I understand people do get concerned about talking about redundancies, having better paid, higher skilled jobs is what we should all be looking for. That is the only way that we're going to escape this low productivity trap. And as we grow our economy coming out of the COVID, the coronavirus recession, this is something you're going to see more and more of: higher skilled, higher paid jobs.
And just as a final question before I go back to the chairs, I appreciate that we're running over. Do you stand by your advice to customers struggling with the increase in their costs of energy to keep warm by doing a few star jumps or having a cuddle with their pets?
I've already apologised for this on numerous occasions. I'm happy to apologise again. The advice was ill-advised, it was insensitive and just inappropriate, and it should never have been sent. What we have done, and to Peter's point, we recognise that we are not always the best placed organisation to give advice to customers, either on energy efficiency or on managing household finances. And in a roundtable a few weeks ago with the heads of the NEA, Step Change, Citizen Advice, I was shocked by the fact that despite this enormous cost of living increase that we're seeing, many of these charity organisations simply don't have the funds to hire enough people to answer the phones that don't have enough money. And so we have a joint initiative with Step Change we just announced recently. We're funding an additional £2 million and making available 50 agents for them to give better advice to customers. That's going to enable, I think, about 250,000 extra consumers to benefit from advice from Step Change. And we know that it's not just energy. The rising cost of living is an enormous problem for millions of households. And I would call on this committee to urge the government to make more funding available for those organisations who are obviously much better placed to support consumers than we are. And we didn't get it right on this occasion, and I hold my hands up and say it was an embarrassing mistake, and I take the offence that we caused to customers very seriously.
Thank you, Chair.
Very final question, Andy McDonald.
Very, very briefly, Chair. I'm grateful for Mr Fitzpatrick's candour. He's already indicated that he will respond to Alan's questions if they're put to him from this committee on a joint basis. But would you understand that also the workforce are gravely concerned here, and the trade union's got to do its job, and they've got their concerns about this web of companies and these loans. We've got Imagination Industries, we've got Vertical Aerospace with money shipping out. They're concerned that the focus isn't on just sustaining the business and keeping those people in work. So I'm asking you now, will you make sure that those books are open to a discussion with Unite the Union, because it's critically important that people are able to represent work. I mean, people are not skipping along to redundancy. They're very upset about losing their jobs. So it's important that there be transparency and openness about the information that's available. So hopefully you could undertake to do that.
I didn't quite get the question. Sorry.
Well, it's to undertake to open the books to Unite, in short, because
I think
it's very important that people understand exactly what this web is, because they don't get it, that this company isn't focused on what it should be doing.
We've had a really good engagement with all of our unions over the past few months, but if there's any specific questions, again, everything is already documented in Companies House, and again, everything is based in the UK, with taxes paid in the UK and jobs created in the UK.
Yes.
We've timed out, but understandably, Mr Fitzpatrick, you must understand that if you've taken £17 million in furlough money from taxpayers, and then I think it's £21 million between OVO Group and OVO Energy coming out in brand royalty fees, at least optically, that doesn't look very good, does it?
Again, I think the licence fee between OVO Energy and Imagination Industries has been in place for 8 years. It's all documented at Companies House. It's a normal business relationship between a brand holder and a licensee. And it's a normal business cost at OVO.
You're the brand holder, aren't you?
I am.
So you could have made the decision not to take the royalty fees at the same year that you took £17 million in furlough money.
the £70 million went to the employees, every single penny of it.
The point I'm trying to get to is it was you, wasn't it? You could have taken the decision not to take in the brand royalty fees.
If it were not for the income that Imagination Industries received from the brand license agreement, it wouldn't have been able to invest in Vertical and pay the salaries of the people that work at Vertical Aerospace based in Bristol. And so this is not everything, again, it's all very open and transparent. It's documented. It's normal. These are normal business arrangements, and that money was used to invest in and pay for UK jobs and create UK companies.
Okay, thank you. Well, there was a number of questions which I think we have follow-up on, so we'll just make sure we clarify that and write to you afterwards, and we'll look forward to getting the answers from you. We're out of time, so that brings the session to an end. So thank you on the screen to Peter Smith from National Energy Action and Jonathan Marshall from the Resolution Foundation, and in the room, Emma Pinchback from Energy UK, Stephen Fitzpatrick from Ovo Energy, and we'll call this session to an end. Order.